Big story, not just the game tonight, but the infrastructure reform. It is still in the works as lawmakers return to Capitol Hill with another proposal. And joining us right now to talk about the plan and the potential impact on the nation's deficit and spending is Michael Zazas. He is Chief U.S. Public Policy Strategist at Morgan Stanley. Michael, it's great to see you this morning. Handicap it for us at this point. What do you think is actually going to happen?
Well, listen, I think this is a pretty sensitive moment for the negotiations. If we go forward with a bipartisan process and you're a bond investor, that's a pretty benign outcome in the sense that you're probably going to get a smaller package that really isn't deficit finance. What we think is going to happen, though, is probably that these bipartisan talks will eventually break down, give way to a Democrats-only process through the budget reconciliation process. And there's probably going to need to be substantial deficit expansion to go along and accommodate that process, because you've got Democratic moderates on the one side in the Senate who want a more limited touch on taxes. But all Democrats seem to agree on multiple trillions of dollars worth of spending. Deficits probably have to bridge the gap on that. And we think they probably will, because the political incentive is there to do that.
Michael, how does what Jay Powell is trying to maneuver over the next 48 hours play into this, which is to say there's a real question of, does the Fed, put its foot on the accelerator, on the brake, take its foot off the accelerator, while the administration and Congress is either putting its foot on the accelerator or taking it off?
Well, I think from the Fed's perspective, they can only sort of watch and wait and see what the actual observed impact is. And so from that perspective, there's a lot to speculate on, but not a lot of hard evidence to move on. Right. And the difference in the deficit impact that we're talking about between a bipartisan process and a Democrats only process is probably in the neighborhood of $400 or $500 billion of deficit expansion. And we're probably not going to know the answer to that question truly, or at least in the way that the Fed would be able to hang its hat on until, in our view, the fourth quarter of this year. So there's a lot of data to observe between now and then, particularly when it comes to inflation. So our sense of it is that the Fed's probably watching and weighing in a lot more on the inflation data than it is on projecting the observed impact of this, even though bond investors are paying a lot of attention to it.
So what do you think the ultimate number is? If you think this breaks down and goes and the Democrats have to figure it out effectively themselves, what kind of number are we talking about?
So our base case bakes in about $4 trillion over 10 years of spending, met by about $1.8 trillion of revenue. So $2.2 trillion over the next 10 years. But we think there's got to be some front loading for that hard infrastructure spend. If we use the American Reinvestment and Recovery Act as a template here, something in the neighborhood of 65 to 70% of that spending after the first 3 years. So the first year deficit hit to us would be about $500 billion next year. It's obviously not as big as the deficit hit this year from the COVID stimulus bill, but it means that, at least in our economists' view, that there's not going to be this sort of cliff to having major stimulus and no stimulus whatsoever in 2022.
Michael, we got to run, but if those who are listening to you, what's the trade? Is there a trade here?
Yeah, I mean, I think this is in line with our expectations of bond yields moving up over the course of the rest of the year. That doesn't necessarily mean that this has to be a rout or a major problem for the bond market, but the glide path should be higher between now and the end of the year and steeper for the yield curve.
Shepard Smith here. Thanks for watching CNBC on YouTube.